Welcome to Debt or Dollars, where we tackle the question, should you pay off a low-interest loan, like 3% APR, or invest the cash instead? In this video, we will move step by step through the real break-even math, the risk realities, and a strategy you can actually follow. By the end, you will know when it makes sense to invest, and when the smarter play is to pay off the loan first. Here is our plan. First, we will uncover the real break-even, not just the headline interest rate. Next, we will examine the risk reality and the behavioral side. After that, we will walk through a decision flowchart to make the choice clearer. Then, we will test scenarios with numbers. Following that, we will outline an action plan you can use. Finally, we will test your understanding with a couple of quick quizzes. Before we dive in, this is an educational video and not financial advice. Your situation is unique, and you should consult a licensed professional who understands your specifics before making any financial decisions. Let us frame the problem. You might have a loan at 3% and spare cash. Conventional wisdom may say that if you can earn more than 3%, invest the cash. However, that is incomplete. Taxes reduce your actual take-home investment return. Your time horizon and tolerance for volatility also matter. Therefore, we need a more accurate break-even and a realistic view of risk. Let us get precise about the break-even. A 3% interest rate is not your true hurdle. You only benefit from investing if your after-tax and after-fee return exceeds 3%. Suppose your marginal tax rate is 22%. Then, a gross investment return of 4% leaves approximately 3.12% after taxes. If there is even a small fee, such as 0.1%, your net becomes approximately 3.02%. Barely above the loan cost. Because of this, your gross hurdle is often closer to 4% or more just to break even. Most safe, short-term vehicles do not deliver that reliably, which is why the simple rule of earn more than 3% is misleading. Here is how to compute your personal hurdle rate. First, note your loan APR, for example 3%. Second, find your marginal tax rate on investment income, for example 22%. Third, estimate your investment fees, perhaps between 5 and 25 basis points. Fourth, compute your net return, approximately equal to gross times 1 minus your tax rate minus fees. Finally, compare the net return to your loan APR. If the net clearly beats the APR with high confidence and an adequate time horizon, investing might be reasonable. Otherwise, paying off the loan is the stronger, lower risk choice. Now, let us consider risk. While the stock market historically exceeds 4% over long periods, short-term results are unpredictable. If you invest money instead of paying off the loan and the market declines, you can lose principal while still carrying the debt. That is leverage risk. For a marginal spread above 3%, taking on additional volatility and emotional stress is rarely worth it for most people, especially if the timeline is short or uncertain. This flowchart starts with the presence of a low-interest loan around 3% APR. The next step is computing your personal hurdle rate after taxes and fees. The key decision is whether your net expected return comfortably exceeds the APR with high confidence and a sufficiently long time horizon. If the answer is yes, the path points to investing excess funds while acknowledging volatility, diversification, and the need for an emergency fund. If the answer is no, it points to prioritizing debt payoff for a guaranteed return and lower stress. The outcomes are contrasted as peace of mind versus accepting market risk. On the left, paying off the loan delivers a guaranteed 3% equivalent return, lowers your monthly obligations, can improve your credit profile over time, and removes market risk. On the right, investing offers the potential for higher returns, but typically requires a long time horizon to reduce the impact of volatility. Returns are taxable and uncertain, and the approach demands emotional resilience and a disciplined risk management process. Let us look at scenarios. At a gross 3.5% with a 22% tax and a small fee, the net return is approximately 2.63%, which does not beat the loan. At 4% gross, the net is roughly 3.02%. which only barely clears the hurdle. At 5% gross, the net around 3.8% does beat the loan. However, in a volatile year with negative 8% gross, your net after fees is worse than negative 8%, and you still owe the 3% interest on the loan, highlighting the leverage risk. Beyond math, behavior matters. Eliminating debt creates mental bandwidth and reduces stress. Lower fixed costs increase resilience if you face a job loss or emergency of death. Additionally, a simpler financial setup reduces the chance of behavioral mistakes, such as panic selling during volatility. These practical benefits often outweigh a small expected spread in returns. Quiz time. If your loan APR is 3%, your tax rate is 22%, and fees are 0.1%, approximately what gross annual return must you earn to just beat the loan after taxes and fees? Option A, about 3.2%. Option B, about 3.6%. Option C, about 4.0%. Option D, about 5.0%. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is about 4%. At roughly 4% gross, after a 22% tax, you keep about 3.12%. And subtracting 0.1% in fees leaves about 3.02%, which barely clears the 3% APR. Second quiz. For the average person with a 3% loan and a short to medium time horizon, which default strategy is typically superior? Option A, invest aggressively now and pay off later. Option B, split 50-50 regardless of taxes. Option C, pay off the 3% loan first, then invest aggressively. Option D, only hold cash and make minimum payments forever. You may pause the video now to consider your choice. We will discuss the answer in the next section. The correct choice is paying off the 3% loan first and then investing aggressively. This approach locks in a guaranteed return, reduces stress, and removes leverage risk. After the loan is gone, you can redirect those payments into investments with a stronger financial foundation. Here is a practical action plan. First, build an emergency fund of 3 to 6 months of expenses. Second, capture any employer retirement match while making regular loan payments. Third, channel extra cash to pay off the 3% loan quickly. Fourth, once the loan is eliminated, automate investments into diversified index funds. Fifth, review your taxes, fees, and asset allocation annually and adjust as needed. This timeline shows a staged approach. In the first quarter of 2025, you focus on building a 3 to 6 month emergency fund. In the second quarter, you accelerate payments on the 3% loan. In the third quarter, you close the loan and immediately redirect the freed up payment into automated investment contributions. From 2026 through 2030, you continue automated investing and perform annual rebalancing. The sequence underscores building resilience first, then turning to growth. Let us recap the math using a simple formula. Net return is approximately gross return multiplied by 1 minus your tax rate, minus fees. The decision rule is to invest only if the net return exceeds the loan APR with high confidence and an adequate time horizon. Make sure to reassess annually because tax rates, fees, and your goals can change over time. Here are the key takeaways. 1. The true break-even is after tax and after fee, not just the APR. 2. Short-term investing while carrying debt adds leverage risk. 3. For most people, paying off a 3% loan is the winning low-risk move. 4. After paying it off, invest aggressively and automatically. 5. The behavioral benefits of peace of mind have real financial value. To wrap up, your gross hurdle to beat a 3% loan is often around 4% or more once you factor taxes and fees. Volatility makes short-term investing risky when a loan remains outstanding. Therefore, a sensible default is to prioritize payoff, then invest with confidence and a stronger foundation. Thanks for watching. If this video helped, please like, share it with a friend, and subscribe for more smart money breakdowns. In the comments, tell us your current loan rate and whether you are leaning toward paying it off or investing. We would love to hear your approach.